Hey guys, we're going to talk about how to make money. And then the various ways we can make money. Remember I told you the stat about if you save $300 a day, eventually that money will make money for you? Well, this is what we're going to talk about and how you can do it. So we're going to talk about how investing contributes to free enterprise, basically how our money will help create more businesses. And the more businesses, eventually the money will continue to flow and our economy will do better, obviously, and hopefully our pocketbook gets better. So investment specifically is putting our money into a business. It's putting it into businesses. It's putting it into all of these resources and in the hopes that these businesses do better. So we understand that we don't necessarily need this money now. We're going to give this money to help make money for us. So an investment is the use of an asset to earn income or profit. When people save or invest their money, their funds become available for businesses. And basically we hope that these businesses expand and grow and blow up. I mean, imagine the person that first invested in Apple before it was Apple today. Putting this, somebody had this extra money to spare, and they put it into Apple, and now Apple is making them millions. So, financial assets specifically are when savers invest, they receive a document. Normally you have a bond book, or you have a stock certificate. These are all different documents. These are financial assets. Basically, these say that you have this money. You just don't have it right this second. So eventually, this money is going to make more money for you. And what do? You put this in the financial system, and the system allows the transfer of money. Basically, the system then takes that money and gives it to the businesses that you've selected. Or if you haven't and you have somebody else doing it, then they will select the businesses for you. Now, the groups that do this are what's called financial intermediaries. There's savings and loans associations and credit unions. There's specific finance companies that literally make loans for small businesses. You have mutual funds, which basically invested into a bunch of stocks and bonds. Matter of fact, I will tell you over and over again, this is the best route to go into because it has some risk, but it also gives you a good bit of reward. Life insurance companies also do this, and pension funds. So in specific, you have savers, right? There's us. We make money, we build up this equity, we build up this money, but we already know that savings accounts don't make us that much money. So we take our money and we give it to all those various financial institutions I just mentioned. They then take your money and basically give it to the investors. So we hope that these investors do really well and expand, such as Apple did, and then they basically will, that money, we can get our money back through them, and the money comes back this way. And so it's just one cycle. Now, I will say, today's day and age, we can get rid of some of these, and the only intermediary we have is like online, such as E-Trade. So we can almost cut out the middleman, and we are now going direct from investor to deposit and depositors to investor. Now, the biggest thing you understand is risk. All right, these intermediaries help us with the risk, but you understand any investment you have, you might lose your money. On the other hand, some are very safe, some are not. But we have to understand that's their job to help us spread out and make sure our investment are right. They also provide us information, and they provide liquidity, meaning they take that asset, that piece of paper, and they will transfer it into money for us. So these intermediaries help us with all of these facets when it comes to stock. Now, again, return and liquidity. Savings account obviously have greater liquidity. You can go right now and transfer money into your debit card, and you know that you have the money. But again, it's not going to make you a lot of money. Savings accounts aren't risky at all. As a matter of fact, they're insured by the FDIC, so you don't have to worry about losing any of that money. But I already told you in the last lecture, you're really going to lose money on putting your money in there, because if you actually count inflation, it's not making you as much. CDs have a greater return. They do have a higher interest rate, but it's not really high. They are safe. Again, you're not going to lose it, but you can't touch that money, though, for whatever set period of time. And if you do touch that money early, you normally lose more money than you would gain. So you have no incentive taking it out, and it really hurts you if you need that money right away. But again, it is a little bit of a return. Then, if you can invest into your friend's business, but the problem is if your friend's business is more likely going to fail. Matter of fact, it's normally not the best idea to invest in your friends. Like them or not, sometimes that's the best idea. Now, that being said, sometimes they might explode, but you have to be careful. We're going to keep talking about return and risk as we keep going. So let's talk about bonds. Bonds are more like loans. When I say loans, you're the bank in this case. The companies basically will get a loan from you. Now, you pay the intermediaries, and the intermediaries basically will give them the loan. Now, they have to repay you. It's an IOU. They have to pay you back. And what they do is they pay you what's called a coupon rate, which is an interest rate that they pay you back. So when you buy the bond, all right, you're giving them that money, and then they have to pay you back with interest. Maturity is how long, though. They have a certain amount of time before they actually have to pay you back. And again, there are fees, or there aren't fees, but the only way to sell it, you have to sell it to try to get rid of it, and not everybody necessarily wants to buy a bond afterwards. And then par value is the amount that an investor pays to purchase the bond, and that will be paid to investor at maturity. Not all bonds are held to maturity. Sometimes bonds are traded or sold, and we'll talk about how that works right here. So let's talk about selling a bond. All right, so let's say you bought a $1,000 bond at 5%. So this paper is worth $1,000 plus whatever the 5% is going to equal you over the period of time. Now, let's say the interest rate goes up to 6%, but you want to sell your bond. All right, you're ready to sell your bond. All right, but Nate here, he wants to buy a bond, but he knows right now he can buy it at 6%, and yours is only worth 5%. So what can you do? Think about it. What are some options? Now that you've thought about it, the best way that Sharon can do to get rid of it, or you, when I referenced you, would be to lower your price. Take off $40 so it makes up for that 1% that they're losing, and that way they're actually, in a sense, getting the same deal. And so your $1,000 bond would now be worth $960, and that's how you could get your money back. But that's how you really get your money. If you wanted to get your money earlier than the maturity rate date, you would have to sell it. Now, bonds have ratings. And ratings go as high as AAA or as low as D. Now, the higher the rating means it's safe, but it also means you're not going to get as much interest because they know they're safe. The lower the rating means it's not safe, but it means higher interest. So you got to be careful where you're at when you're doing it. By the way, people talk about how does the U.S. make their money, and or why does the U.S. always owe money? Well, the U.S. owes more money from bonds than most other areas. Matter of fact, U.S. government bonds are what people normally tend to buy because they're normally safe and they have a very high rating. Now, bonds, again, are not as risky, though if the company were to fold, there is a slight chance they might not have to pay you back, but for the most part, they do have to pay you. But it's still not as high risk. Or it's not as high risk as, say, stocks. But it's not as high reward either. Once its bond is sold, it does not go up or down. You are stuck with what it is, even if it has gone up or down in that company. And you are not buying any part of the company. Advantage to the owner, obviously they don't have to, or disadvantage to the owner, it would be that they have a fixed interest payment. They have to make sure they pay you back on it. And even if it's downgraded, they still have to sell the futures in discounted prices. There are savings bonds, as I mentioned, treasury bonds, municipal bonds, corporate bonds. Each one of these are various types in which you can get it for different ones. I'm not going to focus on those today. Again, we talked about a CD. A CD is a savings account on steroids. It is a higher risk rate, but it is a high rate of return, but not really as high as it could be, but very low risk. My suggestion, it would be mutual funds. Mutual funds buy CDs. It buys bonds. It buys stocks, and it diversifies. It puts your money in multiple different areas. Matter of fact, I want you to remember that word diversify. Diversify means spreading your risk out so that way you're not running into a situation where you have all your money in one basket and then that basket tips over and you lose all your money. Mutual funds are probably, they still are a little risky in some regards, but that being said, because it's spread out in so many different areas, they're in general going to make you money. So you have to make sure of that. But notice right here it says it is not insured, so it is taking a risk. Some of your money might go away based on what happens. But I would say that's really the best way to make money. All right, let's skip on into section 3 here. So we're going to talk specifically about stocks. Stocks, we already talked about, is the company giving you part ownership. Now, that being said, it's a very small piece of the ownership. You're not really making any decisions, but you are, in a sense, getting a piece of the company. And so you're hoping that company goes real well. Now, there are two ways stock owners make money on this. One's what's called dividends. And basically it can be quarterly or it can be annually, where they will actually pay you based on the company's profit. So if the company's doing really well, they'll actually write you a check for your portion of what the stocks you owe. Also, it's when you sell your stock. Obviously, we want to buy low and sell it high. That's how you make your money. You buy it when the company's at $9, and hopefully the company gets to 15 or 20 by the time you sell it. So you want to buy low and sell high. And that's, again, the best way for how you make money on stocks. Now, stocks have the biggest bang, but they also have the biggest fall. Let's talk about dividends. Dividends can, again, as I already mentioned, come at regular times in the year, or they could be few times. Matter of fact, some stocks don't have any. They actually put their money into and reinvest into the company. Investors who buy common stock do have voting rights, and they can, but there's also preferred stocks where you do not have voting rights. Now, they may be classified either by whether or not they pay dividends or whether or not the stockholders can say with the corporation's affairs. Now, a stock split is even better for you, and that's what you hope. You hope you buy a stock and that you're riding on the ride of the stock. You buy it at $9 and it just keeps getting where it's like $100. And what they do is they realize people can't afford the $100, so what they'll do is they'll split it. And so now your one share is worth $2. Now, think of it like penny or a dollar bill. A dollar bill is worth 100 pennies. So in a sense, you now have 50 you have 50 cents in each one, but people can buy it from that way. And then those two stocks can make you money. So you definitely want a stock to split. A stock split occurs when the price of stock becomes too high. People don't want to buy it, so they split it so that way they can buy a smaller portion of the company, but they can buy it at a lower price. Again, you really want your stock to split it if you can ride it for a long time. But in general, stocks are meant to be rode over a long period of time, by the way. It is not a buy a stock today and sell it tomorrow. It's a years over time, and stocks in general normally continue to rise to the occasion. But there are risks. It's actually one of the riskier ones. If the company fails, you lose your money. Gone. See ya. Have a nice day. But on the other hand, if that company explodes, man, you can become very wealthy very quick, such as the Apple example I talked about earlier. Again, how are stocks traded? Stockbrokers on the stock exchange firms. Though today, I will say the stock exchange still exists, obviously, but you can actually avoid the stockbroker and go through E-Trade or various companies there. But we do have what's called the New York Stock Exchange, which is the largest stock exchange. It only stocks for the largest, most established companies are traded here. Then there's the NASDAQ. It specializes in high-tech energy. And there's the OTC, which is the over-the-counter market. And there's also day trading. So these are all various ways that you can that your companies are buying and selling stocks and exchanging it. There are what's called futures. Futures are contracts to buy or sell on a specific date, or options, which is buy or sell on a specific either price. They either want to sell it at a higher price or at a lower price. And so they do have those as well. We have what's called also bull market or bear market. A bull market is one where the stocks continually to rise. A bear market is the opposite, where things fall. So if you ever hear something as a bear market, that's not good. A bull market is what we want. Hence, if you think about the bull out in the front of on Wall Street. Again, there are averages. These averages actually have gone up for the past couple of years. As a matter of fact, to all-time highs as of recently. Last thing we're going to talk about is the stock market crash. So long story short, what happened is people were they would get loans, and then they would take these loans and put it into stocks. Well, think about it. If their stock goes bad, they can't pay it back. Now, obviously, people were hoping it wasn't. So, hoping it would go well, and it did at first, but then the stock fell. Well, the next thing you know, people couldn't pay their money back. So the next thing you know, banks were loaning out that money. They didn't have the money. Then banks didn't have your money. Then people were afraid to start running and taking their money out of the bank. Next thing you know, banks ran dry. Because banks ran dry, the market fell altogether. And so when the market fell, businesses fell. People lost their jobs. We were down at one point where I want to say only one in every 3 people had a job, where it should be a lot higher than that. Obviously, it led to long-term depression. People lost their jobs, homes, farms, money. People lost everything. Matter of fact, a lot of people in this time period started saving their money and doing that. How did we get out of it? We had the Great Works program in the World War II, which allowed us to really build up some money flow. All right. Hope you learned something. If you have any questions, come see me on Monday.